Welcome to Wealth Wisdom Works. My name is Alan, and on this channel we talk about all things money, finance and investing. That's also what I cover in my book, The Wealth Wisdom Blueprint, which is available on Amazon. I'll leave a link to that in the description below. Today we're going to take a look at avoiding investing mistakes. Before I start, I'm not a financial advisor, so any information I give is for entertainment purposes only and does not constitute financial advice. Always consult a financial advisor for specific advice relating to your individual circumstances. Now, I'm not here to judge. We've all made mistakes, especially when it comes to investing. But the good news is, with a little bit of education and awareness, you can avoid some of the most common investing mistakes and set yourself up for financial success. Before we dive in, let's talk about why it's so important to avoid investing mistakes. Simply put, investing mistakes can cost you money. And let's be real, no one wants to lose money, especially when it comes to something as important as your financial future. That's why it's crucial to educate yourself and be aware of some of the common pitfalls that many investors fall into. Now, I'm not here to scare you. Investing can be a rewarding and exciting journey, but it's important to approach it with caution and knowledge. And that's where I come in. I'm here to share some of the common investing mistakes that I've seen over the years and offer some tips and strategies for avoiding them. But before we get started, I want to emphasise that investing isn't just about avoiding mistakes. It's also about learning and growing. And that's why I recommend reading books, attending seminars and watching videos like this to educate yourself on the ins and outs of investing. Trust me, the more you know, the more confident and successful you'll be in the long run. So with that said, let's dive into some of the common investing mistakes and how you can avoid them. Whether you're a seasoned investor or just starting out, there's something for everyone in this video. So sit back, grab a notebook, and let's get started on the path to financial success. Mistake number 1, failing to plan. Alright, let's jump into the first common investing mistake, failing to plan. Now, I know what you're thinking. Planning can be boring and time consuming, but trust me, when it comes to investing, and here's a cliche alert, failing to plan is planning to fail. Having a plan is crucial to investing success. It helps you identify your financial goals, create a timeline, and determine the best investment strategy for you. Without a plan, you're just shooting in the dark and hoping for the best. So how do you create an investment plan? It starts with setting financial goals. Whether you're saving for retirement, a down payment on a house, or just building wealth, it's important to have a clear goal in mind. Once you have a goal, you can create a timeline to achieve it and determine the amount of money you'll need to invest to get there. Next, you'll want to determine your risk tolerance and choose an investment strategy that aligns with that. Are you comfortable with high risk, high reward investments, or do you prefer a more conservative approach? Once you've determined your risk tolerance, you can choose from a variety of investment options, such as stocks, bonds, mutual funds and real estate. Now, some common mistakes people make when failing to plan include not having a clear goal or timeline, and not considering the risk tolerance, and not diversifying their investments. By avoiding these mistakes and creating a solid investment plan, you'll be well on your way to achieving your financial goals. Remember, investment is a journey, and having a plan is just the first step. Stay tuned for the next part of the video, where we'll discuss another common investing mistake and how to avoid it. And if you want to learn more about investing and personal finance, be sure to subscribe to this channel for more videos like this. Okay, mistake number 2, overreacting to market changes. Let's move on to the second common investing mistake, overreacting to market changes. We've all been there. You've seen a headline about a stock market drop or a sudden spike in a particular industry, and before you know it, you're making snap decisions about your investments. But here's the thing, the stock market is unpredictable, and short-term changes often have little bearing over the long-term trends. By overreacting to market changes, you could be making a costly mistake. So how do you avoid this mistake? It starts with taking a disciplined approach to investing. Rather than making snap decisions based on short-term market trends, focus on your long-term goals and stick to your investment plan. That means resisting the urge to sell off your investments when the market takes a dip, and avoiding the temptation to buy into a hot stock just because it's in the news. Another key strategy is diversification, which we'll touch on in a minute. By investing in a variety of assets such as stocks, bonds and real estate, you can spread out your risk and reduce the impact of short-term market fluctuations. Now, some common mistakes people make when overreacting to market changes include selling off their investments in a panic, buying into a hot stock without doing the research, and not diversifying their investments enough. By avoiding these mistakes and taking a disciplined approach to investing, you can avoid the dangers of overreacting to market changes and set yourself up for long-term success. So mistake number 3, lack of diversification. Okay, let's talk about the third common investing mistake, which is a lack of diversification. Have you ever heard the saying, don't put all your eggs in one basket? Of course you have. Of course you have, it's an old cliche. Well, the same goes for investing. By not diversifying your investments, you could be taking on unnecessary risk. Diversification is one of the best ways to reduce risk in your investment portfolio. By spreading out your investments across different asset classes and industries, you're less vulnerable to the ups and downs of any one particular investment. So how do you create a diversified portfolio? It starts with understanding your risk tolerance and investment goals. From there, you can choose a mix of stocks, bonds and other assets that align with your risk portfolio and help you achieve your financial goals. Another key strategy is to regularly rebalance your portfolio to ensure that your investments remain diversified. And this means selling off investments that have become overvalued and reinvesting the proceeds of that into other assets. Now, some common mistakes people make when lacking diversification include investing all their money in one stock or one asset class, failing to regularly rebalance their portfolio and not considering the risk tolerance when choosing investments. By avoiding these mistakes and diversifying your portfolio, you can reduce the risk and increase your chances of long-term success. So mistake number 4, ignoring fees and expenses. So let's have a look at this fourth common investing mistake, ignoring fees and expenses. When it comes to investing, fees and expenses can add up quickly and eat away at your investment returns. By ignoring these costs, you could be leaving money on the table. Fees and expenses can have a significant impact on your investment returns over time. For example, if you invested £10,000 into a fund with a 1% expense ratio and a 5% annual return, you'll end up with $26,000 after 20 years. But if you choose a fund with a 0.25 expense ratio, you'll end up with $32,000. So that's a difference of £6,000. So how do you identify and minimise fees and expenses? It starts with doing your research and reading the fine print. Look for funds with low expense ratios and avoid funds with higher fees and charges. You should also consider investing in index funds or exchange traded funds, which tend to have lower fees than actively managed funds. Another key strategy is to regularly review your investment portfolio and make sure you're not paying unnecessary fees or expenses. This means periodically checking your account statements and talking to your financial advisor about ways to reduce costs. Now, some common mistakes people make when ignoring fees include choosing high fee funds, not reading the fine print, and failing to review their investment portfolio regularly. By avoiding these mistakes and being mindful of fees and expenses, you can maximise your investment returns and achieve your financial goals faster. Remember, every penny counts when it comes to investing. So on to mistake number 5, timing the market. Okay, we've come to the final common investing mistake, timing the market. Trying to predict short-term market fluctuations and buying or selling investments based on these predictions is a risky strategy and it rarely pays off. In fact, studies have shown that the majority of professional fund managers are unable to consistently beat the market, let alone individual investors like you and me. By trying to time the market, you could be missing out on long-term gains and exposing yourself to unnecessary risk. So how do you avoid this mistake? It starts by taking a disciplined approach to investing and focusing on your long-term goals. Rather than making snap decisions based on short-term market trends, stick to your investment plan and resist the urge to buy or sell based on predictions. Another key strategy is to regularly review your investment portfolio and rebalance it to ensure that it remains aligned with your risk tolerance and investment goals. By doing so, you'll be able to take advantage of market opportunities without trying to time the market. Now, some common mistakes people make when trying to time the market include buying and selling based on predictions rather than facts, failing to take a disciplined approach to investing, and not regularly reviewing their investment portfolio. By avoiding these mistakes and focusing on the long term, you can achieve greater investment success and reach your financial goals. Remember, investing is a marathon, not a sprint. Another cliche which I've used a few times before, but it's true. So, conclusion. Well, that's it. We've covered the 5 most basic common investing mistakes and how to avoid them. So let's do a quick recap. First, failing to plan. To avoid this mistake, create a plan and set financial goals that align with your risk tolerance and investment timeline. Second, overreacting to market changes. To avoid this mistake, take a disciplined approach to investing and resist the urge to make snap decisions based on short-term market trends. Third, lack of diversification. To avoid this mistake, create a diversified portfolio that includes a mix of stocks, bonds, and other assets that align with your investment goals and risk tolerance. Fourth, ignoring fees and expenses. To avoid this mistake, do your research, read the fine print, and regularly review your investment portfolio to minimise the costs. Finally, timing the market. To avoid this mistake, take a long-term approach to your investing. Stick to your investment plan and resist the urge to make decisions based on short-term predictions. Remember, investing is all about balance and discipline. By avoiding these common investing mistakes and focusing on your long-term goals, you can achieve greater investment success and reach your financial goals faster. So, if you're looking to take control of your finances, understand the basics and grow your wealth, then this is a channel for you. Make sure to like this video and subscribe to my channel to keep up to date with all my latest videos, and let me know down in the comments which topics you want me to cover in future videos. Thanks for watching. Remember to check out my book, The Wealth Wisdom Blueprint, and I'll see you in the next video.